Okay, so for this example, we're just going to run through another one. So we're asked to find a cash statement for day one and a balance sheet for JG Limited at the end of the 1st of September, so which is just on the first day of trading. And we've got these 6 points to go through. And then once we've done that, we are then asked to find another set of cash flow, income statement and a balance sheet for the period of the 2nd of September all the way to the 30th of September in that first month. So this is a little bit more involved than the previous case. But let's get started. So it reads, in August, the company was set up. And it buys and resells used denim items. So these first 6 points, take a screenshot if you want, actually it'd be easier, and then you can just refer to it as we're going along. So again, the first thing to do, a cash flow statement. Normally you would set up an income statement as well after that, before doing the statement of financial position or the balance sheet. And the reason you do that, why, is because what does the income statement tell you? It tells you the reinvested or the retained profits. And those retained profits ultimately go into the statement of financial position under equity. So normally in equity you'd have two headings. You'd have share capital and then you would have retained profits. But since there was no trading done on the first day, there won't be any retained profits, and therefore the retained profits on the statement of financial position will be zeros. There's no point doing an income statement on the first day, or if there's no trading. So let's go straight in. So again, the first thing is, and again, the whole approach to doing these problems is to do everything at once. Don't do an income statement, don't do a cash flow and then do income statement and then do statement of financial position. If you're clever about it, you can do the whole thing at once, and I find that is the best way to do it, so that it avoids any errors and mistakes. So let's go into the cash flow. So again, setting up a cash flow. So just write down here, cash in, two headers. So we'll have all the cash in, boom, 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 something like that. And then we're going to have that's going to go in this column. And then the sum of those things will go over here, just like this. That'll be the sum. And then we'll have the cash outflow, cash out, again, same format, boom, 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 and then we're going to have the total cash outflow, all right, and then we can then work out what the net cash flow will be. And then we'll have the opening, we'll add that to the opening balance. And then that will give us our final closing balance on the 1st of September over here. Done. Lovely. Now let's look at the income statement. Well, we said there's not going to be an income statement because there's going to be no retained profits. There's no trading done on the first day. So in fact, the question just says explicitly there, cash statement and a balance sheet as well. So let's set up the balance sheet. So the balance sheet, statement of financial position at 1st of September. Very important to write at as well, because we know what we're looking at now. So we can say the revenue. Actually, no, I'm doing an income statement, aren't I? That's silly. Okay, so we'll have assets. So start with the non-current assets over here. And there'll be boom, 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 boom. We'll give some space for that, boom. And then we'll have the total non-current assets over here. Sorry if you can see that, okay. Then we'll have the current assets. Boom, 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 boom. And then the total of the current assets that will go in that column over there. And then we can sum them up and we can say the total assets. Okay. And then we can say over here, equity. and that will obviously normally be like a share capital and then retained profits, reinvested profits. We know that's going to be 0 here because, remember, no trading on the first day. And then we can have the non-current liabilities. Boom, boom. Things like loans, bank loans, things like that. Liabilities that you expect to have for longer than 1 year. And then a total non-current liability will go over here. And then we can have the current liabilities. Okay, short-term obligations. And then we can have the total liabilities over here. Okay. And we can have the total equity over here as well. Fine, so let's go and have a look at those problems again. So I'm just going to bring up the sheet again, just so you can see it over here. Just take a screenshot of that so you can see as we're going through. So let's move that out of the way. Now, number 1, so we've got issuing to Jean 40,000 £1 ordinary shares at £1 each. So immediately £40,000 in, so that's cash in. 40,000 pounds in over here, and that's going to be share issue. Shares, share capital, and that's going to increase our equity. Share capital 40,000. Okay. Proceeds placed to the bank account. Great, that's why we got the cash. Next, number 2, purchased equipment for £7,200 cash. So that's going to be cash out, £7,200, and that was that equipment? So equipment, £7,200 cash, and inventories of denim items for £8,000 on credit, so that's not going to be on the cash statement. Inventories, that will be our current asset. We increased £8,000 of denim on inventories, £8,000. But we bought it on credit, so that's going to be a current liability of £8,000, and that will be trade payables. Okay, because we owe them £8,000. We've increased the assets. Our inventories are £8,000, but we didn't do anything with cash because we haven't paid for it yet. So let's read number 2 again. Purchased equipment for £7,200 cash. That's taken care of over here. Our non-current asset, that will be an equipment. And on the first day, and also non-current assets is always net book value. And that's important because it takes into account depreciation, assuming there's no depreciation on the first day. So we can say £7,200. Okay. So let's read number 2 again. Purchased equipment for £7,200 cash taken into account, put onto the non-current asset. Net £7,200 in non-current asset, good. And inventories of denim items, that's a current asset because we expect to get rid of it fairly soon, within the year. On credit items, so trade payables, again, we expect to pay that off within the year, so that will be £8,000. Credit terms for trade suppliers. Equipment to be depreciated straight line over 6 years. Now depreciation would only go on a income statement anyway. It wouldn't go here, but it would be recognised over here. So if there was any depreciation, then we would just reduce the net book value of the equipment. But it's the first day, so we don't have to worry about doing that. Good. Number 3, obtained a £5,000 bank loan. Okay, so that's £5,000 immediately in cash in, bank loan. Just put that there, £5,000. And deposited the cash in the bank. That will be bank loan non-current liability, bank loan of £5,000, because we don't expect to pay that within the first year. Okay, that's fine. I always read it like at least twice, just to make sure. Obtained a £5,000 bank loan, cash in the bank, in non-current liability £5,000, Yeah, okay. Number 4. In the morning, purchased a motor vehicle for £7,200 cash. So that's another £7,200 cash on motor vehicle, on cash outflow, to be depreciated straight line over 6 years. We don't worry about depreciation on the first day. And paid, but we do need to add that into the non-current asset. So we put motor vehicle, net book value, 7,200. And paid rent for 12 months of £12,000 in cash. So we paid £12,000 in cash immediately. Cash outflow for rent. Paid rent for 12 months. Okay, so if you paid, now rent normally would not go on the statement of financial position, except here it would, because you've actually bought an asset. The fact that you have paid for it for the whole year is a prepayment. So prepayment would be in the current asset. Prepaid rent, 12,000. And we paid for that in cash over here. Yep. Okay. Rent also would go as an expense per month on the income statement if it's monthly or yearly, whatever that is. And then number 5, discussed contracts with potential employers. Nothing there. And then number 6, in the afternoon, Jean found £2,000 in the attic and purchased another £2,001 ordinary shares in the company. So that's £2,000 in the bank from shares. And that's going to increase her capital, £2,000 share capital. The cash was paid into the bank account, and also £1,000 was used to repay part of the bank loan. So £1,000 goes out, bank loan payment, and that reduces the bank loan non-current liability from £5,000 to £4,000, like that. So now let's add things up and see what we get. So first of all, the cash flow. So 4 plus 5 plus 2 is £11,000 cash in. Now let's do the cash out. Cash out, 7.2 times 2 plus 12 plus 1 is 27.4. So that's 27,400. Oops. 27,400. I've just made a mistake here. This is 40,000. So that's going to be 40 plus 5 plus 2. So that's actually 47,000. Minus 27.4 gives 19.6. 19,600. No opening balance. Closing balance, £19,600. And that closing balance, £19,600, will be a current asset in cash, 19,600 on the statement of financial position. So now we can start to add up total assets. So over here so we can see what we're doing. So 7.2 times 2 plus 8 plus 12 plus 19.6 gives us £54,000 in assets, and hopefully that will equal the equity plus total liabilities. So 40 plus 2 plus 4 plus 8 gives 54. So we can see that the total, the equity plus total liabilities, £54,000 equals the total assets, £54,000. And now what we can do, we can move on to stage 2, which asks us to compute the cash flow, income statement and statement of financial position at the 30th of September. So going from the 2nd. And then from the 2nd of September, it will take the closing balance over here, which will be the opening balance of the new cash flow. And the statement of financial position will need to be adjusted as well. So let's go and do that. So what we have our statement of financial position at the 1st of September. And for clarity, what I'm going to do is I'm just going to say, I'm going to write in a different colour. I'm going to say the statement of financial position at the 30th of September, because we can just make the adjustments over here, and the new cash flow statement over here that we've got. So let's have a look. So I'm just going to bring up the snapshot of the tasks that the statements that happened. So as we can see, we've got 6 different things that happened here. So you want to take a quick screenshot of that. Do that now, and then we can go through all the different steps and see how that's going to generate a new cash flow and a statement of financial position. The other thing as well that I just forgot, obviously we're going to have a profit and loss statement as well, an income statement, because it was trading that went through, meaning we're going to have to work out what the retained profits were. So again, I'm just going to do this over here for because it's a little bit squashed in, but I hope you can read that. So we've got revenue, cost of sales. Revenue less cost of sales will give us our gross profit. Okay. And then we're going to have all our expenses. So we'll have expense here, and then we'll have our total expenses that goes over here. And if we take the expenses away, so our gross profit less expenses, and that's going to be our earnings before interest and tax. Okay, that's going to go over here. Important figure. Gross profit is also important. EBIT, and then we're going to have our interest, which will go over here. And then we're going to have, that will be our profit before tax. Is that right? Profit before tax. Yep, and that will go over here. Less tax. And then we'll have our profit after tax, profit for the year. Okay, and then if we may have some dividends. And then we'll have our retained profits over here. Okay, so let's have a look then. So number 1, during September sold for £13,000 cash, denim items which had cost £4,000. So we sold for £13,000 cash. So we can write here immediately, £13,000 sales. Okay. Sold for £13,000 cash, denim items, and that will be our revenue, £13,000. Okay. Items which had cost £4,000. Okay, so that's going to be our cost of sales, £4,000. Now, remember here in the statement of financial position, we've got inventories at £8,000 in assets. Well, if we sold £4,000 of that, that's going to change, isn't it? So now that's only going to be 4,000. So we can cross that out. We can write 4,000. Okay. Is anything else going to happen there? During September, sold for £13,000 cash. That'll be the cash flow is correct. Revenue, £13,000. Again, that's selling something whether or not you received it or you didn't receive the money. We definitely sold £13,000. That's fine. Denim items which had cost £4,000. Cost of sales was £4,000, and that's reduced out in inventories by £4,000. Is that going to affect liabilities or anything else? No, it's not. Okay, so I think that's okay. So number 2, wages earned by staff during September total £2.5 £2,500. So that's going to be an expense, operating expense, £2,500 over here, £2,500. £2,000 of that was actually paid, so cash out, £2,000 wages, which means that if she forgot to pay the other 500, so that will be in the current liability, £500 wages payable. So again, read it again, just to make sure. Wages earned by staff during September, total £2,500. Expenses, accruals, that's correct. £2,000 of that was paid, £2,000 cash went out, correct. But then there was a liability incurred of 500 because she forgot to pay it on the current liability, would increase by 500. Okay, also paid trade suppliers £7,000. Well, she owed 8,000. If she paid 7,000, that means it's gone down, doesn't it? So it's not 8,000 anymore. It's now 1,000 because she paid them 7,000. And it also means that if she paid them £7,000, I'm assuming that's in cash. £7,000 for trade or trade payables. Okay. And that does not go on the income statement. Trade payables does not go on the income statement. All right. These are just operating expenses. Okay, so number 3. On the 30th of September, received an electricity bill for £200 for the month of September. So that's £200 for electricity. It is due to be paid during April. So she hasn't paid it yet, so that's the current liability of £200 on elec payable. Okay, electricity payable, 200. Is that correct? Yes, I think it is correct, yeah. Okay. Number 4, paid cash for advertising costs of £1,000 for the month. So £1,000 went out in cash for ads. Expenses during that month, £1,000 for advertising. And because that £1,000 of advertising is not something that she owes, it's not going to be going to increase liabilities. And because it's not an asset, it's not a prepayment, it's not going to go in assets either. Okay. So that's paid cash for advertising of £1,000 for the month. £1,000 went out, £1,000 on accruals, nothing on the statement of financial position will change. Fine. Number 5, received bills totaling £4,000 for the month of September, relating to a range of operating expenses, and paid £3,000 of that sum. So £4,000 operating expense. She paid £3,000. Of that, which means that she owes £1,000. Current liability will increase. Various operating expenses, VOE. Okay, so that's £1,000. By the way, VOE doesn't mean anything. You can write anything here. Let's read it again. Received bills totaling £4,000 for the month of September. £4,000 operating expense. Paid £3,000 of that in cash. That will mean the current liability on that will be £1,000 because she needs to pay that. Number 6, paid bank loan interest of £50 for the month. So paid £50 bank loan for the month. Well, that's the interest, so that will go over there. Okay, £50 on the interest. Paid a bank loan interest of £50 for the month. She actually paid it. and paid £500 off the bank loan. So she paid out £500 off the bank loan. This bank loan on the non-current liability was at £4,000, but it's not going to be £4,000 anymore. If she paid £500, it's now going to be £3,500. Now, what we can do is that we need to now add up the cash flow statement, because the closing balance will be the amount of cash that is actually in the bank, and that's going to adjust this cash flow figure over here. So let's go ahead and do that now and find out how much cash we have. So just adding up all the cash out, we've got in thousands 2 plus 7 plus 2 plus 7 plus 1 plus 3 plus 0.5 times 1,000, 13,500 plus £50. Okay, so that's 13,550. 13,550. 13,000. Take away that, and that's going to give minus £550. Minus 550. Opening balance, remember, was the closing balance of what we had before, which is 19,600, and that's just taken from the cash flow statement that we did previously over here. So this is our closing balance of the previous cash flow statement, 19,600. So we can now say that minus 550 plus 19,600 gives 19,050. 19,050 pounds for our closing balance. So we can now look at our cash on our current assets and change this from 19,600 to 19,050. So that's taking care of the cash. What about reinvested profits? So for our reinvested profits, well, that will go over here, or retained profits. Retained profits is always in equity. Okay, we need to work out the profit and loss statement. So let's go ahead and do that. So we've got revenue minus cost of sales gives us £9,000 gross profit. £9,000 gross profit there. Okay, let's add up all our expenses. So we've got 2.5 plus 0.2 plus 1 plus 4 gives us £7,700 of operating expenses. So 9 minus that gives us £1,300 EBIT. 1,300 EBIT. This is not actually correct. I've just noticed something that we forgot. The rent, and this is a bit tricky, this part here, because it wasn't mentioned on number 2, but it was mentioned on number 1. We forgot to put a rent expense in there. Okay, so if we look back to the first figure, we can see that there was a rent that we prepaid at £12,000. Okay, number 4. In the morning, purchased a motor vehicle, and paid rent for 12 months, £12,000 in cash. So what we should have done there is this is why it's a bit tricky, that one. Put a note, because our current assets prepaid rent, okay, at £12,000. Well, that £12,000 is for a whole year, yeah? So divide that by 12 is going to be £1,000 per month. So now that is actually not worth £12,000 anymore. That's worth £11,000 because it's the prepayment for the rest of the year, the rest of the 11 months. And we need to include that rent in expenses as well. So we must put rent in there of £1,000 for the rent. Okay, because it was, remember, rent is on accruals. That was a little bit tricky, that one. So we'll just change that to 8,700. And that means that this will go down to 300. The other thing we have to do, this is why I would recommend not doing the the income statement first. I would sort out what you can on the statement of financial position, ignoring the retained profits, because it's gonna help pick up any of these issues here. So what we've got is that we picked up prepaid rent is at now £11,000, and that should indicate, that should kick into your conscience that, well, there should have been a £1,000 accruals, which we've put over here, plus 1,000. But let's have a look at other things. So in the current assets, the equipment net book value £7,200, and the motor vehicle £7,200. If we go back to the to that previous sheet, it said that it depreciated at for 6 years down to nothing. So 7,200 divided by 6 is 1,200 per year, divided by 12 months, £100 per month. So this is now going to be worth 7,100, and this is going to be 7,100. Okay, so we've got £200 of depreciation, plus £200 of depreciation. So before you do the income statement on anything complex like this, I would always do the statement of financial position in terms of its assets, current assets, liabilities, before you look at the equity on the retained profits. So that basically has triggered these additional expenses. So if we now add up the expenses, operating expenses, we've got 2.5 plus 0.2 plus 1 plus 4 plus 1 plus 0.2 gives £8,900. Okay, so we'll just write that one in at 8,900. And then that obviously gives us an EBIT of £100, less interest, £50. Tax is nothing. Profit after tax will therefore be 50. Are there any dividends? No. So retained profits will be £50. And then with that, we can easily just pop that back into retained profits over here, £50. So now we've worked out our retained profits, and we've also worked out our new cash from the cash flow, retained profits from the income statement. And any other adjustments I don't think need to be made. So we can start doing the addition, and let's see what everything comes to now. So let's add this up. So 7.1 times 2. Plus 4, plus 11, plus 19.05 gives £48,250. Total assets. Equity, 40,000 plus 2 plus 50 gives us £42,050 in equity. And if we add up our liabilities, we have 3.5 plus 1 plus 0.5 plus 0.2 plus 1 gives us a total of £6,200 of liabilities. So if we add up 6,200 total liabilities plus 42,050 of equity and liabilities together now total